as engaging, stimulating, and exciting it is, we all have to work at some point. Okay? And we work in different capacities. So some work as employees, some work as independent contractors, right? And as we work, we incur a certain type of expenses, right? For which we're not reimbursed by our employer or client or whatever. And the question becomes, are these expenses deductible on tax return? And this is what we'll study today. So the important thing that I want you to keep in mind is that, again, as a default, nothing is deductible, remember, unless you could point something that you satisfied some requirements in order to make certain expense deductible. Okay? So you got to go through a number of hurdles. Okay? One thing that I'll address quickly, and that is, what kind of a deduction? Is it above the line or below the line? Well, as a general rule, if you're in your own trade or business, if you're an independent contractor, you have your own business, then as a general rule, those expenses deductible above the line, right? If you're an employee, you work for somebody else, then those expenses, as a general rule, deductible are below the line, with some exceptions like moving and so on and so forth. Okay? And if you're an employee, they're deductible below the line as a general rule, subject to 2% adjusted gross income floor. That's also miscellaneous itemized deduction. So the big question, the first question, before we get into details, is to understand where we are. Are you an independent contractor or an employee? And guys, a lot of you get in trouble. I want to red flag it right now. Not with me, in life. Because you get jobs, these part-time jobs or whatever, and your employer says, okay, you're going to be independent contractor. He makes you sign independent contractor agreement. And you're like, yeah, I'm an independent contractor, cool. You incur some expenses, you go to your tax preparer or you do it yourself, say, oh, if I'm an independent contractor, I could deduct my expenses where? Above the line, which is more benefit, better, right? The problem is that just because your employer tells you you're an independent contractor doesn't mean you're an independent contractor for tax purposes. And a lot of people have a lot of problems with it. What IRS looks at is the substance of the relationship. You could, now, for the employers, generally, it's better to call you as an independent contractor. Why? They don't have to pay for your benefits, buy workers' compensation insurance. Liability is also better because, you know, if an employee, your employer is more liable. If you're an independent contractor, there's more protection of liability. So employers are kind of pushing people to the extent possible to be independent contractors. What the government says is, look, it's not about how somebody calls you or how you call yourself, it's the substance. Okay? And we'll look at all facts and circumstances to see, is it really employer-employee relationship? Okay? If you have your own tools, you work out of your own office, you'll get paid per project, and you determine what and how to do, then you're probably running your own business. It's just, and it's any and all facts and circumstances come into play. But if your employer pays you per hour, gives you tools, you work in their offices, you know, the more of these facts, the more likely you're going to be treated as an employee. Ultimately, it's the control over ways and means to get to the end result. That's the ultimate question. So if the employer says, well, not just what to do, but how to do it, and here's what you do, and here's the steps you follow, then it's control, a lot of control. Then it's more likely than not it's going to be treated as employer-employee. Is that clear? I just wanted to address this important point because you will ask me, okay, so where is it deductible? Well, it depends. Is it employee? Then it's generally below the line. If it's independent contractor, above the line. And we'll discuss some exceptions. Okay, so you raised the question today, which I wanted to answer now, and that is the most basic cost when you work is to getting to work and back from work, right? So let's say you're home and here's your work, and you go from home back to work. Let's say you take a train. What is it, 250? Sorry. 275 and back 275. Question, is this deductible? No. Why? It's called commuting expense not deductible. Now, in reality, to expand our minds a little bit, is it really related to producing income? Yeah. And it probably should be deductible. But for policy reason, the government made a decision, commuting expense not deductible. Just tough to monitor. Some people could decide to live really far and incur big expenses. The government says, look, it's really your choice how far you live. All right? So at the end of the day, general rule, commuting expense not deductible. Now, there are some exceptions. So, if you incur extra, for example, expenses, how? Well, I don't know. You're in construction, you have to carry heavy tools, and because of it, you have to drive in. Normally, it would take you $275, but because of it, it takes you extra $5 one way, so it's $775. Okay? Well, then extra $5 becomes deductible. Is that clear? Because normal $275 commute not deductible, but the additional cost, this $5 if you have to carry, for example, heavy tools or whatever other reasons, the excess beyond your basic normal commuting expense becomes deductible if it's due to because of your business. If your employer pays for your commute, you have no expenses. So there's nothing to deduct, so there's nothing to discuss. That's a separate question. That's a separate question. We'll come back to it. I just want to zoom in on this for now. Okay? Any questions on this? So if somebody reimburses you, you have no expenses to deduct. There is nothing to discuss. Now, if you go from home to work 1, and then you have a second job, work 2, and back home, anything deductible here? From work 1 to work 2, right? That's not commuting. And if you're in public accounting, the more senior you get, the most of your day is just traveling between clients. I mean, if you're within the city region. All this becomes deductible. Okay? Now, another interesting exception is, what if you go from home to work 1, but then you go back home before you go to work 2, and then back home? Anything deductible here? Yeah. The government says there's really no difference if you go straight to work 2 or you go home first and then go back to work 2. Maybe you want to have lunch at home, I don't know. Or say hello to your Miss Wolfson before you go to second job. Then the government says, still, we pretend that you went from work 1 to work 2. So even though you never went from work 1 to work 2, we pretend that this happened, and this amount is still deductible. Okay? Even though you never really went from work 1 to work 2, but we pretend that you did. And that cost from work 1 to work 2 is deductible. Any questions on this?
So you mean that if you from home, if you go to work, you come back home, you go back. So either way, one way is
different jobs, first of all. Different job. This is work 1, this is work 2. Okay? So, because you need to get to, if you simply work in the same job, you just happen to want to go home and come back to work, there's no deduction. If you have different jobs, well, you have to get from one job to another job. That distance is deductible. Some people have 2 jobs. They do taxes during the day and they dance at night. Yes?
But then if your first job, if you don't have one, then you have to go to another place for a certain job that you usually don't do, then that
Yeah, if you get assigned, like stations, what you, I hope you guys write in advance. If you have temporary workstations, then traveling to temporary workstation is deductible, but I don't want you to worry about it. There was another question here?
I was going to ask if that's the same thing as, like, say you're in public accounting, you're going from client to client.
That's exactly what I was talking about, right. So you go to your office first, and then you travel from client to client to client to client. All that becomes deductible in your tax return. Okay? Now, what if you go away to a conference to learn more about taxes? Is that trip deductible? Where is our expert? Mr. Depends. Is that deductible? It depends. That's a good question. I thought you were our expert. So is that deductible? Yeah. So the answer is, if it relates to your trade or business, it depends whether it relates to your trade or business. You know, if you're an accountant but you go to a conference on meditation or salsa dancing, well, it doesn't relate to your trade or business. It has to relate to your trade or business. What if you bring your significant other with you? Can you deduct his or her expenses? It depends. It depends on what? If your wife is your assistant, you're saying? Or if you're assistant to your wife? Or, at the end of the day, if you guys in the same trade or business, right? In other words, if your spouse or boyfriend, girlfriend would independently qualify to deduction, then it's fine. Okay? Yeah?
So what if the conference, let's say, on the weekend, on one day, and then you stay for the...
Excellent. So the question is, what if there is a mix of business and personal? And this is the real topic for today. What if we do both? Well, it depends. First, if we're talking about domestic or international travel. So, first of all, if it's local, there is no travel, to answer your question. Whatever days are business, it's deductible. Whatever days are personal, those expenses not deductible. Okay? That's just to make it clear. But if you're traveling, and if you're in travel status, then all of a sudden new expenses could get deducted, but you got to demonstrate that you're in travel status. What do you need to show that you're actually in travel status? Tickets? You have to be away from home for the day that is substantially longer than your normal working day. Okay? It need not be more than 24 hours, but if you're traveling somewhere away from home, you could take a train somewhere or whatever, car, then you become in travel status. If the day is substantially longer, then all of a sudden your ordinary and necessary expenses, which normally you don't get deduction for, become deductible. Like what? Meals. Can you normally deduct the food you eat? No, but if you are in travel status, then it's deductible. Only with meals, there's a cutback of 50%, right? Because the government says you still have to eat. It's just maybe when you're traveling, it's more expensive, so half of it will give you deduction. But you could only be so much in travel status, right? If you're in travel status for more than a year, you're no longer in travel status. The government says, you moved, my friend. So it's got to be temporary. There's got to be intent to return. Yes?
How about if you travel from place to place? Like you never stay longer in one place?
Yeah, there's a story about this traveling salesperson. He was selling diamonds. And he was on the road most of the year, like almost 300 days a year or something. And he was from hotel to hotel. Sounds like these old deductions. The government disallowed deduction, all of them. Guess why? Because in order to be traveling, you have to be away from home. The government says, you don't have a home. This is your home, this is your home, this is your home, this is your home. It was a very interesting case. Taxpayer at that time showed some leases somewhere, but the government said, no, that's all nonsense. You live on the road, that's your life. These are your expenses. Okay? If you fly, the same thing. If you travel overseas, doesn't change.
But what if he had like a family, like somewhere in?
You know how many people have families somewhere?
No, like he's like you know his own children, like his wife, and house is under his name.
And they never see each other. These are some of the happiest couples. They never argue. No, you have to demonstrate that you have a home. And home is where generally you spend most of your time. If most of the time, or in that extreme case, really was pretty much the whole year, then it's a problem. Unless, of course, your wife and kids travel with you all the time, but then it just shows once again that these are your homes. Okay. So the issue becomes, and I want to go back to the question that was raised, what if while you're traveling, you have both personal days and business days? Well, the easy part is, you know, personal, business. Whatever money you incur during personal days are personal, and that's not deductible. Hotel, food, right? That's simple. If it's a business day, then it's deductible. By the way, what makes a day business or personal? How many hours do you have to work? 10 hours? 8 hours? There's no hour really requirement. Just as long as there is no fraud, as long as you really did business, even if it's few hours, but this was your business day. As long as there is no abuse, of course. So that's simple if there is both business and personal. But what about this? This is airplane, in case you don't recognize it. Let's say it costs you $1,000 to fly there and back. What about this $1,000? Because we can't say it's a business trip because some days business, some days personal, right? You see the issue? Your question is about pilot? Is airplane considered pilot's home? Because he's traveling. Well, usually when you fly airplane, hopefully, you don't sleep there. So the airplane would not be considered his home. Usually pilots, when they get out from airplane, they go to hotel or home. So airplane would not be their home. And if you ask me, what about hotels? Can they say that this is... And the answer would be the same as traveling salesperson. If they fly most of the year and, you know, most of the year to sleep in hotels, the government could theoretically make an argument that they don't have a home. But in practical terms, it's not an issue for pilots because airline pays all their expenses generally. So there is no issue. It's airline's expense. But you know, I'm always wondering how these guys live their lives, you know? They travel all the time. I talk to them. I used to do a lot of flying. There's a point in my life when I was flying twice a week. And I see sometimes, you know, still same crews and all that stuff, and we got crazy life, you know? Always sleeping somewhere. Some people like it, maybe. Okay, so what happens here? That's the question. And the answer is, it depends whether the trip is primarily for business or not. So we are right now in domestic travel topic. Domestic, okay? Meaning within the United States. Meaning not international. So if you're flying domestically, then you could deduct the entire cost of the trip if there are more days spent for business than personal. Because then the trip is primarily for business. Primarily means most days of business. Any questions here? So individually, in individual days, if it's business day, it's deductible. If it's not business day, the expense not deductible. But overall of getting there and back, the whole thing deductible, the whole expense deductible if the trip is primarily for business, okay? Any questions? Now, that's pretty simple stuff. It gets more complicated, more expensive when we talk about international travel where special rules apply. So international travel, first of all, the default rule is it's not all or nothing. It's we allocate, which is what you guys like to do. Accountants always like to allocate, prorate, make it fair and reasonable, right? Your default say, okay, it's 20% was personal, 20% not deductible. We try to keep it simple for tax purposes. But international, the stakes get higher generally because the trip is more expensive flying internationally, unless you fly to Canada or Mexico or maybe soon to Cuba, right? Then the default rule, you allocate. Okay, so whatever percentage of the day is used for business is business, whatever percentage of the day used for personal is personal. Now there are some interesting rules that are applicable in this area, and that is, please write it down. Number one, the days when you fly are business days. Okay? Again, presuming there is no abuse, presuming the trip was taken primarily for business person. Intervening days are also business. You know, if you get stuck in the airport and you couldn't fly out. Okay? Also, if the day before the weekend or holiday and after is business, then what's in between becomes business also. So for example, if Friday you work, it's business. If Monday you work, it's business. Then Saturday, Sunday become business also. Okay? So just keep in mind these rules. And the last point is there are 3 exceptions where we do not allocate the overall cost. And we'll go back to, is it all or nothing? Is it primarily business or not? The first exception, please write it down. If the entire trip is 7 days or less, if the entire trip is 7 days or less. Second exception, you don't need all of them. Either one is enough. If less than 25% of the trip is personal, if less than 25% of the trip is personal, and third, if the taxpayer has no substantial control over the arrangement of the trip. No substantial control over the arrangement of the trip. Okay? So, you know, you're just sitting waiting for instructions from clients or from boss, and meanwhile you decided, you know, you couldn't do anything. You went to a museum, whatever. That's fine. As long as you have no substantial control of the arrangement of the trip. In that case, if you meet any one of these 3 requirements, you go back to domestic travel rule, essentially. And is it all or nothing? Is the trip primarily for business? And if yes, the entire cost of getting there and back is deductible.